Hello, and welcome to the Tax Justice for All, Unveiling the Racial Inequity of the U.S. Tax Code. I'm Colin Longmore, Outreach and Education Specialist.
And I'm Sister Emily Tukolsky, Grassroots Mobilization Coordinator. Today's workshop is designed as an interactive session, so we encourage you to pause the video throughout the workshop to have some conversation with those joining you for the session, or just to reflect on your own.
Before we dive in, I want to invite you to take a moment to ask yourself if there's anything that might keep you from fully engaging in this workshop. If so, what is it? Is there anything you can do to mitigate its impact? While we know that life happens, we also believe that the content of this workshop is really important to creating the world that we want to see. We also know that it is challenging for many of us to learn. So we want to invite you to engage your full self by acknowledging any emotions or feelings in your body that come up as we work through the content tonight. We invite you to observe and acknowledge while withholding judgment for yourself and for others. For those of you who are not already familiar with Network, we are a Catholic social justice lobby founded by Catholic sisters. We educate, organize, and lobby for economic and social transformation through federal policies. We strive to build our country anew through policies that dismantle systemic racism, cultivate inclusive community, root our economy in solidarity, and transform our politics.
Today, we gather to explore how deeply the U.S. tax code is woven into questions of racial and gender justice, and to envision an alternative tax system that will generate the revenue for social programs that will build our country anew. You can download the slides you see on the workshop's website at networklobby.org/taxjusticeforall. We're especially grateful for our partners at the National Women's Law Center and Americans for Tax Fairness for their work that inspired this project, as well as their technical assistance. We're also grateful for our partners at the Institute on Taxation and Economic Policy, ITEP, who provided assistance with some of the tax wonky details.
Today's workshop will have two main parts. First, a look at how the current tax code impacts 5 different families who hold different socioeconomic identities, followed by your chance to explore a variety of policies that we could pass in order to build our tax code anew. But before we get into those parts, I want to start with setting some groundwork. As we enter into conversations that might be a little uncomfortable or difficult, Network staff has developed these shared agreements that we strive to use when engaged in conversations about racial justice. And we invite you to root yourself in these agreements for today's session as well. So some of these are speaking up and making space. Maybe you are someone who normally has your voice heard in spaces. Maybe you're someone whose voice isn't heard. We encourage you to either speak up if your voice isn't heard or to make space for others during this conversation. Also acknowledge that we are experts in our own experiences and that in any type of reflection coming from that place. We ask that we respect confidentiality, but to continue the conversation, another way that anything that is shared, if we were to be doing our in-person workshop, to stay here, but anything that is learned, to definitely go out and to continue the conversation from whatever was learned. Whether or not it has been named, the personal manifestations of power are present in its many forms. We also encourage you to practice self-care. This is a little bit of a longer workshop, so whatever you have to do to practice self-care through this, we encourage you to do so. We also encourage all to embrace and express discomfort as we dive into some of these topics that might be a little bit challenging. And to also recognize that resolution will not happen today as part of that longer effort. Finally, we ask to make space for evaluation of progress and tension as we go through our content today. And if we are in agreement with these racial justice shared agreements, we'll dive into our next portion.
Today, we're going to go on a journey through the tax lives of 5 different individuals or couples. We'll explore how the tax code impacts them in 6 different milestones of their lives, from birth and early childhood through retirement and inheritance. Before we begin, it's important to note that the tax code does not exist in a vacuum. The social context and economic history of our nation are very much relevant as we assess the racism present in the US tax code, especially the degree to which the current tax code privileges wealth. If you want a primer on some of this economic history, I suggest joining us for our Racial Wealth and Income Gap workshop. What's most important to remember is that wealth in the United States is highly concentrated in the hands of white families. As you can see in this chart from the US Federal Reserve, the differences are massive. And here we can see in this chart from the Brookings Institute how that breaks down across household income percentile. As tax law professor Dorothy Brown writes in her book, The Whiteness of Wealth, white families are equally likely to have zero wealth as they are to be millionaires. Black families, on the other hand, are 20 times more likely to have zero or negative net wealth as they are to be millionaires. And Latinx families are 14 times more likely. The way the current tax code privileges wealth means that it contributes to the growing racial wealth gap. And the data tells us that's bad for everyone. In their research, based on just about every public health indicator, public health experts Kate Pickett and Richard Wilkinson find that quality of life is worse for the richest person in a highly unequal society than for the richest person in a highly equal society. As you can see in this chart, the US is highest of all similar nations in both income inequality and worse health and social problems. The impacts on the individual in each society are just magnified as you go further down the income ladder. It's important, though, to be clear that the disparate impacts of the tax code on Black families are not only a result of economic circumstances. Implicit bias and implied social codes also contribute in significant ways, as we'll see, to the racial inequity of the tax code. Put simply, if we make the tax code better for Black women, the tax code will be better for everyone.
So with that, let's meet our characters for this journey. First, meet Sarah. Sarah is a single Latina mother who earns about $30,000 per year. She works full-time in the service industry to support her young child in public elementary school. She relies on the child tax credit to help pay for childcare. Next, we have Steve. Steve is a single white man who brings home about $60,000 per year. He works full-time at a public relations firm, a job that he got after graduating college, and he's in the process of paying his student loans. And his company has agreed to pay him to go back to school and to get a master's degree. He lives in an apartment in the city and has no problem with paying his rent on time.
Next, we'll have two couples who both earn a combined $90,000 per year. Derek and Gabrielle are Black. They both work at a Catholic high school where Derek is a teacher and Gabrielle is an administrator. They are both paying off student loans from graduate school and are saving to put up a down payment on a house in the suburbs. Derek has picked up extra hours tutoring after school to bring in more money. Joe and Melissa are white. Joe recently got promoted to manager at his bank, and Melissa left the paid workforce to care for their two children because of the cost of childcare. They own a condo in the city and rely on their annual marriage bonus to cover costs of living.
Finally, we have Ken and Lisa. Ken and Lisa are wealthy and white, and they're white because the vast majority of wealth in the United States is in the hands of white people. And they earn $5 million per year. Ken is a real estate developer and Lisa a stay-at-home mom. They put all three of their children through private college and they own 2 homes. Ken and Lisa donate to charities and they support a progressive wealth tax as long as there is no capital gains tax on their investments. So as we go through this experience, we invite you to imagine yourself as one of these 5 families. You can follow that family through your persona, through the 6 life milestones to see how the tax code would impact you as that person, as that family, in comparison to the other profiles. So we invite you to take a moment to pick a lens to walk through. And as a quick note, each of the milestones will focus on a select few of our families in order to highlight the tax code's impact most clearly. But we'll close each milestone with a graphic view of the overall impact of the tax code on every family.
So let's get started with milestone 1, birth and parental wealth. For this first milestone, we'll highlight policies like the Earned Income Tax Credit, which subsidizes low-income workers and helps prevent them from being taxed into poverty. We'll also talk about the Child Tax Credit, which provides a subsidy for children, and about 529 accounts, which provide tax incentives for saving money on behalf of children to invest in higher education. In particular, we'll focus on the differences between Sarah and Steve. Imagine that Sarah and Steve grew up in the same city, only a few miles from each other, and yet with vastly different childhood experiences. Sarah's parents worked low-wage jobs, making them eligible for the Earned Income and Child Tax Credits. Until the American Rescue Plan, these credits were not fully refundable, meaning that they couldn't always access them, even if they were eligible. This was a short-term temporary expansion, and the credits will revert to where they were before, unless we include them in the current recovery work. Alternatively, Steve lived in a single-earner household with a stay-at-home parent. His parents' job provided health insurance, a benefit not provided to Sarah's parents, and enabled his parents to invest in pre-tax retirement savings accounts. They also brought home enough extra money to invest in a tax-advantaged 529 account to save some money for Steve's college expenses. Steve's parents could also afford to purchase a home, and the homes easily available to them were in predominantly white neighborhoods where home values were more likely to grow, and to grow in larger amounts. The ability to purchase a home enabled them to take advantage of the mortgage interest tax deduction and extend the mortgage over a longer period of time, allowing them to live more comfortably and to invest more money in Steve's 529 account and their own retirement accounts. Furthermore, the tax code allows for homes to be sold for tax-free gains of up to $500,000. When Steve's parents sold his childhood home for $100,000 more than they had originally paid for it, they could invest that money directly into Steve's college without paying any taxes on it as income. Sarah's parents couldn't afford or didn't trust traditional savings options or banks, so they didn't have a good credit score, which is calculated on the way so that white and wealthy people spend money. And they could never earn enough money to save up for a down payment. They could never earn a home or take advantage of these tax benefits for homeowners. Here's an overview of the scale we're talking about in terms of the differences in tax benefits.
Next, we're looking at milestone 2, which is education. As we talk about education, we'll highlight the impact of the policy on student loan interest deduction, which allows taxpayers to deduct student loan interest. And we'll also return to the 529 accounts that we briefly mentioned as related to personal wealth. So for this milestone, we're going to focus our comparison on the 3 families that we haven't seen yet: Derek and Gabrielle, Joe and Melissa, and Ken and Lisa. And let's start with housing, which is the basis of primary and secondary educational quality in a U.S. public school system funded predominantly by local property taxes. Joe and Melissa's schools were located in a high-value neighborhood, and so they were better funded than Derek and Gabrielle's schools. Because both Joe and Melissa only had one parent that worked outside of the home, as did many of their classmates, their parents could be more involved in the classroom and in extracurricular activities, further adding to the resources available in their schools. Going a step further, with Ken and Lisa, they went to prestigious, well-funded private schools with other well-resourced people. In many states, tuition vouchers help wealthy folks offset the cost of private schools. Moving on into college. Both of the white couple's parents were able to invest in tax-advantaged 529 accounts to save money for college. Ken and Lisa were able to pay for college tuition and all fees and living expenses with parental money. Joe and Melissa were able to pay for a significant portion of their college expenses through the savings and income from their parents' early investments, but they still had to take out some student loans. Following graduation, they could deduct student loan interest from their taxes up to $2,500. Meanwhile, Derek and Gabrielle's parents couldn't afford to set aside money in those tax-advantaged investment accounts, so they weren't able to build up wealth to help pay for college. They had to take out substantial loans, and while they were able to deduct their student loan interest from their taxable income, they still ended up having more in student loan interest than they could deduct from their taxes. Unlike the preferential tax treatment for 529 accounts, which applies to gifts of up to $15,000 per gift giver per year with no income limits, the allowed deduction for student loan interest maxes out at $2,500 and only applies to those who are under an income threshold of $85,000 for an individual or $170,000 for a couple. Unlike nearly every other provision of the tax code, that $2,500 allowable deduction does not double for married couples filing jointly. So together, Derek and Gabrielle are only allowed to deduct $2,500 from their taxable income. Furthermore, the large amount of debt that Derek and Gabrielle had to take out in order to pay for college made it harder for them to save up for a down payment on a home, leaving them unable to take advantage of the tax benefits of homeownership for a full decade beyond when their white counterparts could take advantage of these provisions in the tax code. Student debt, along with slower income growth than their similarly educated white peers, is among the leading contributors to the growing racial wealth gap. Millennials in particular are hard hit. More than 84% of college-educated Black households in their 30s have student debt, up from 35% 3 decades ago, when many baby boomers were the same age. The amounts of debt are far, far higher. So for this milestone, let's take a look at the scale of the tax code impact among our families. And as we see these, we invite you to take a second to reflect. What are you thinking? What are you feeling? And how is your adopted persona doing? And how do you feel about that?
Milestone 3, employment-based income. The impact of the tax code on employment-based income includes joint filing, which is when a married couple files taxes together as a single unit with tax brackets that are about twice as wide, meaning the income level at which they pay a higher marginal tax rate is much higher. Here we'll focus on the comparison between Sarah, Steve, and Ken and Lisa. Sarah did not graduate from college, but started working multiple low-wage jobs to provide for her child. These jobs did not come with benefits like health insurance or retirement savings, which made building savings and wealth more difficult. Despite growing corporate profits, she rarely sees a raise. Real wages have stagnated since the 1970s. Meanwhile, Ken and Lisa saw a huge increase in employment income. Corporate CEO compensation grew 1,070% between 1978 and 2018, driven partially by a 1993 law that provided preferential tax treatment for so-called performance pay, like bonuses and stock options. A recent report from the Economic Policy Institute says that by 2020, just 2 years after this chart finishes illustrating, that number had increased to 1,322%. We know that this is not tied to stock growth because it is over 500 percentage points beyond stock growth during that same time period. Over just the past 2 years, 2019 and 2020, CEO compensation grew by 18.9%, and CEOs at the top 350 public companies in the US were paid $24.2 million on average in 2020. So we've been talking about Ken and Lisa, but remember that they make only $5 million per year. It doesn't sound like 5 million is only, but compared to the average of the top 350 CEOs, it's not a lot. Steve and Ken and Lisa are able to receive tax-free health benefits from their employers. When filing taxes, Ken and Lisa see the greatest overall advantage with a top marginal tax rate below 40%, less than half of what it was at its height. For comparison, the top marginal tax rate was 50% or above between 1932 and 1986, and above 90% between 1951 and 1963, and for 2 years in the 1940s. Ken and Lisa also make income above the $142,800 eligible to be taxed for Social Security. All additional income above that amount is exempt from the additional Social Security tax. Steve gains some advantage from the decreasing marginal tax rate, but as he is not in the top income bracket, he doesn't see nearly as much as Ken and Lisa. He is able to get more benefits by claiming itemized deductions, which reflect expenses he can afford due to his higher income. Steve is also able to deduct his student loan interest from his taxable income, while Ken and Lisa are able to take advantage of the joint filing bonus, which primarily benefits those couples who have a significant difference in income. Note that in Black families, the average income split between partners is 60 to 40. In white families, the average split is 80 to 20. The joint filing bonus is much more likely to benefit white families than families of color. Sarah is able to take advantage of the earned income and child tax credits, but may not have been able to take full advantage of the amount that she was eligible for, because up until the American Rescue Plan's passage earlier this year, these tax credits were not fully refundable. I also want to note here that Sarah's income barely covered her daily expenses, so she often had to take on personal debt, often at high interest rates, to meet any urgent or emergency needs. Unlike mortgages and student loans, the interest on personal debt, including medical debt, is not deductible under the tax code. It's worth reminding you here that health insurance benefits from your employer are a source of tax-free income. So medical insurance is tax deductible, but medical debt is not. It's not just based on the socioeconomic status that Black workers are more likely to find themselves in due to generation of systemic oppression. As Dorothy Brown reports in The Whiteness of Wealth, researchers found that median wealth would go up 25% for Black workers in all fields if they had equal coverage rates for healthcare, and 53% if pension rates were equalized. The two main forces driving this disparity are the types of jobs that Black workers are funneled into, and the increase in companies relying on contract work to avoid paying benefits. In 2016, a report on subcontracting in Silicon Valley showed that Black and Latino workers made up 10% of direct hire employees, 26% of white-collar contract hires, and 58% of blue-collar contract hires. So let's take a look at what all of this means together.
Next, we're going to milestone 4, which is capital-based income. Capital-based income is particularly unique and privileged in the US tax code. The capital gains tax rate is about half that of the earned income tax rate, and unrealized capital gains, which is the increase in the value of a stock in a given time frame, is not taxed until those stocks are sold. For this milestone, we're going to focus on our couples and look at how retirement savings and investments vary for each of these couples. After college, Joan, Melissa, and Derek and Gabrielle were able to obtain jobs at similar companies that offered generous health insurance and retirement savings options. Their experience with these benefits, however, were vastly different. Joan and Melissa were able to save for retirement much more easily and more quickly than Derek and Gabrielle. While Joan and Melissa's parents had some wealth that they could use to help establish college savings or provide gifts for their grandchildren, Derek and Gabrielle often had to assist their parents and other family members with expenses. This is what we refer to as an upward generational transfer of wealth. This made it harder for them to invest in their own savings for retirement or for their children's education. Researchers have found that financial transfers to parents are much more common among Black college-educated households and significantly decrease household net wealth by more than 25%. Without this additional financial strain, and often with tax-free gifts given to them from their parents, white households are 4.5 times more likely to receive a gift or inheritance. Joe and Melissa could put more money into investment accounts, and thus they benefited from those special capital gains tax rates. To an even greater extent, Ken and Lisa were able to take advantage of early investments and thus the capital gains tax rates. In addition, the tax code preferences capital-based income by not taxing the increases in stock values when they occur. This is known as unrealized capital gains. Waiting instead until the stocks are sold. Both Joe and Melissa and Ken and Lisa are able to take advantage of this to very differing degrees. And add to all of that the question of tax avoidance. The IRS estimates that the wealthiest 1% of US households hide 21% of their income and are able to get away with it due to lax enforcement capacity. A recent ProPublica article investigated the amount of taxes paid by the 25 wealthiest Americans compared to their wealth growth from 2014 to 2018. And during that time, for the ultra wealthy, their wealth rose collectively by $401 billion, but they paid $13.6 billion in federal income tax, which comes out to be a true tax rate of only 3.4%. In 2011, Amazon CEO Jeff Bezos held $18 billion in wealth, but was able to use deductions and losses from his side investments to offset his taxable income, enough to claim a $4,000 child tax credit without paying a single cent in federal taxes. And here's what this would all look like. Here we invite you to pause the video and to reflect on these 3 questions, either on your own or with a short small group conversation. The first is, how are you feeling? The second is, what are you learning? And finally, how is your adopted persona, your adopted family, doing?
All right, welcome back. And we're going to go right into milestone 5, family and housing. On the personal side of things, how taxes impact and interplay with your family, we will be talking about imputed income, which refers to the non-monetary benefits that are not subject to taxation. We'll also talk about the mortgage interest deduction, which allows people to deduct the interest paid on their mortgage from their taxable income, and tax-free gains in home equity. Each of the 3 couples we'll be following for this milestone were able to purchase homes, but they purchased them at different times in their lives and in different ways. Ken and Lisa, in fact, didn't even purchase their first house. It was a wedding gift from their parents. Joe and Melissa were able to purchase their first home several years after graduating college, after paying off their lower student loans, and with the assistance of parents who gave them a gift towards the down payment. Due to the mortgage interest deduction, it made sense for them to spread their mortgage out over a 30-year period and invest the monthly savings from deferred payments in their retirement accounts, where they could earn more money in stock growth than they would have saved in interest payments. Derek and Gabrielle had to wait longer to be able to purchase a house because they had more student loans to pay off before they could begin saving for a down payment. During this time, they had to pay rent while building no equity toward full homeownership. When looking for neighborhoods for their first home purchase, Joe and Melissa settled in a predominantly white neighborhood where they felt like they fit in and where home values were reliably increasing. Derek and Gabrielle had to choose between a predominantly white neighborhood where they were likely to feel like outsiders and a mixed race community where home values were not increasing as quickly due to the concentration of purchasing power, wealth, in the hands of white folks, and the preferences of those white folks who prefer to live in majority white neighborhoods. In addition to impacting property taxes and thus educational opportunities, this also has a significant impact on the way the tax code benefits each family. When Joe and Melissa's house increases far more in value by the time they sell it, they can still take the entire gain tax-free. The tax code allows homeowners to take gains up to $500,000 tax-free when they sell their homes. This same policy has a significantly smaller impact on Derek and Gabrielle, whose home doesn't grow in value as much just because of the racial makeup of where they live and the purchasing choices of white wealth holders. Derek and Gabrielle were also able to take advantage of the mortgage interest deduction, but this benefited Melissa and Joe more because their home was worth more. Ken and Lisa were gifted their house, and so didn't take advantage of the mortgage interest deductions, but their house's value grew significantly more than either of the other couples. And they maxed out the home equity deduction, bringing home $500,000 in gains without paying a penny in taxes on it. In addition, both white couples, Joe and Melissa and Ken and Lisa, benefited from the joint filing bonus by having primary breadwinners. They gained imputed income that was untaxed. This describes the offset expense of things like childcare and home cleaning that don't have to be paid for if one parent can take on that responsibility. So while Joe and Melissa and Derek and Gabrielle were bringing home the same amount of money, Joe and Melissa saved a bunch of money by not having to pay for childcare, while Derek and Gabrielle had to pay for childcare because both parents were working. I guess a penny saved is worth more than a penny earned because you don't have to pay taxes on it. Let's take a look.
So now we're going to milestone 6, which is retirement and inheritance. For our final milestone, we're going to be talking about inheritances and most egregiously, what's known as the stepped up basis of inherited assets. This is in which the base value of an asset like a stock is revalued when the ownership transfers through an inheritance. Neither the original owner nor the inheritor of that stock will ever pay any taxes on the value growth of the asset that happened during the original owner's life. To explore these, we're going to focus on three very different profiles: Sarah, Joe and Melissa, and Ken and Lisa. So like many people of color, Sarah reaches the latter part of her life with a high debt to income ratio, which was accrued over the years from things like medical bills to credit cards and personal loans. Since the interest on this type of debt is not tax deductible, she receives no benefit from the tax code. Additionally, instead of receiving an inheritance or wealth from her parents, she incurred the additional informal expense of financially supporting her parents in old age, that upward generational transfer of wealth we mentioned earlier, which is not tax deductible. This all severely limited her ability to save, to invest, to build wealth, and thus to retire. She keeps working for far longer than Joe and Melissa or Ken and Lisa, and likely relies on her adult child for financial support later in life. Joe and Melissa were able to rely on their retirement, on their savings, and on other investments for a decent standard of living in their retirement. Additionally, like many white families, they receive a modest tax-free inheritance from their parents. And they benefited from the inheritance tax loopholes like the stepped up basis that we mentioned, which allows an inherited stock to be revalued at the inherited value for the purpose of capital gains tax, without ever having paid taxes on the gains made during the previous owner's life. The gains made from the sale of the home that they reared their children in provide additional tax-free income to be invested or saved to fund their retirement. Going to Ken and Lisa, they receive all of those benefits, but at a much, much higher rate, thanks to their various high-value investments and wealth that they hold. With things like estate and other inheritance loopholes in place, they're able to avoid taxes on up to $23 million inherited from their parents. So all in all, here are the scale of differences. As we can see, massive benefits for Ken and Lisa, moving all the way down to someone like Sarah, who is almost virtually locked out from this one. So from here, we're going to invite you once again to either reflect on your own or in a small group to talk about these questions. One is, what is your overall impression of this experience, of these 6 milestones that we've walked through? Second is, what differences did you notice in the experiences of our 2 couples, Joe and Melissa, compared to Derek and Gabrielle? These were our 2 couples, one white, one black, who made the same amount of money. And 3, which milestone had the disparity that most surprised you? And what about it was particularly surprising to you? So take a moment, pause the video, and have this reflection either with yourself or with a small group, and we'll be back soon. Welcome back, everyone. I hope you had some good reflection or small group discussions. As we transition to the next part of our workshop, I want to start with a quick response question. In your mind, or maybe you can make a list answer to this question. If you could snap your fingers and provide full funding to one government program, what would you fund? So maybe in thinking about it, you might choose something like universal healthcare or universal housing. This is your time to dream big. What government program would you fully fund if you could snap your fingers and provide that funding? So as you've thought about it, here is the truth. We could fund those programs, all of them that we've all come up with, if couples like Ken and Lisa and those who make much, much more than them paid their fair share in taxes. So what we're going to get right now is a chance to re-envision our tax policy and our society with our tax justice calculator, which is available online at networklobby.org /tax justice calculator, all one word. I'm going to pull this up so you can see what it looks like. Here is our tax justice calculator, build your own budget tool. And this will be part of the next exercise that we do today. Using this tool, you get to choose between 15 revenue generating policies and 15 spending policies. To select one of these policies, all you have to do is click on the little checkbox right next to it. And you can see the update on the bottom of the page in a graph that is interactive and responds to whatever it is that you choose. So we saw that first policy that was chosen, and we see the revenue that was made here. And if you pick a spending policy, let's say you want to provide affordable internet to everyone, we click on that, and on the bottom we see right there at the very bottom the spending that is added into the chart as well. So during this, we're going to give you time to play around, to build your own budget, to choose between those spending policies, those government programs that we have in mind, and to fund them through various tax policies that we see on the left as well. As you consider the policies that you want to select, we also want to invite you to reflect on or to discuss in your small group or by yourself the following questions. What are your overall impressions of this tool, of this activity? And maybe what's a hard choice that you had to make in choosing between these tax policies and the different spending policies? So again, you can find this tool on networklobby.org/tax justice calculator, and it's also available on our webpage of Tax Justice for All. And with that, we'll give you time to play around, to build your own budget, and to see how we can re-envision this tax code together.
All right, welcome back. I hope you had some good conversation, did some good exploring, learned a few things. Now let's move this from our imaginations into reality. So we're going to start with a reminder, this chart from earlier, that health and social problems are worse for everyone in countries that are more unequal. But this doesn't have to be the end of the story. We can move the US from the very top of this chart closer to better health and social indicators and lower levels of income inequality. So today, you can be a part of the solution. Call your representative and senators to encourage them to support a faithful recovery by repealing the 2017 Republican corporate tax credit, strengthening IRS enforcement to prevent tax evasion, and ensure that the ultra wealthy pay their fair share. Make sure they know that you want them to use these resources to fund critical programs like a permanently refundable child tax credit, paid family and medical leave, rental assistance, and closing the Medicaid coverage gap. To learn more, we recommend the book The Whiteness of Wealth by Dorothy A. Brown, a tax law professor at Emory University. We also recommend the series of reports from the National Women's Law Center that inspired this project, particularly the shared executive summary, Tax Justice is Gender Justice. Other awesome resources are available through the Institute on Taxation and Economic Policy, ITEP, and Americans for Tax Fairness, ATF. And please join Network in advocating for the kind of racial and economic transformation we need to build our society anew. You can get action alerts by texting justice to 877-877, or find out more about our advocates teams by emailing info@networklobby.org. Thanks for joining us today and for the long haul to build our society anew.